Step onto any retail trading floor, scroll modern financial content feeds, or listen to institutional portfolio managers dissecting emerging market fintech, and you will routinely encounter a profound fundamental misdiagnosis of New Holdings Ltd. Trading near $15.23 per share, with a market capitalization hovering above $73 billion, New Holdings is casually dismissed by legacy market observers as just another high-growth Brazilian digital lender or a speculative credit card proxy vulnerable to Latin American macroeconomic volatility. This is where Wall Street consensus completely misses the structural reality of the business. Traditional analysts look at New through the lens of legacy banking metrics, fixating on headline non-performing loan ratios or short-term local interest rate cycles, while entirely overlooking the underlying physics of digital financial infrastructure, a zero-legacy, cloud-native, hyper-scalable architecture that functions less like a regional bank and more like an ultra-high-margin software platform operating at continent-wide scale. While legacy financial media and mainstream retail investors fixate on surface-level sentiment, jittery macro headlines, and transient currency fluctuations, they remain completely blind to the foundational architectural moat that allows New to scale its customer base past 139 million users while driving its cost to serve down to fractions of a dollar. Retail traders caught up in daily price swings fail to recognize that New's core operating engine is powered by an advanced artificial intelligence infrastructure, specifically platforms like Newformer that handles the vast majority of customer support interactions, while continuously optimizing real-time credit underwriting across multiple sovereign jurisdictions. This is the hidden structural reality. Traditional banks are trapped inside legacy mainframe silos, encumbered with thousands of expensive physical branches and bloated operational overhead that scales linearly with every new customer added. New Holdings, by contrast, operates with a negative cost curve. Every additional user added to its app-first ecosystem compresses fixed overhead per account, expands proprietary data loops, and refines automated risk models in a self-reinforcing flywheel that traditional brick-and-mortar institutions cannot replicate. When quarterly net income prints cross the historic threshold of $1.10 billion, standard market commentators express momentary surprise before retreating to old habits of questioning credit risk. They treat the achievement as an outlier rather than the inevitable mathematical outcome of an operating model designed from day one to extract maximum leverage from software architecture. The market mispricing lies precisely here. Investors are pricing New as a cyclical bank exposed to emerging market beta when it is fundamentally scaling as a dominant digital utility network whose structural unit economics are fundamentally decoupled from the high-cost paradigms of the 20th century financial system. To truly understand how New Holdings trades on a daily basis, one must examine the intricate choreography between retail panic and institutional accumulation. Whenever macroeconomic jitters hit Latin American currencies, or when short-term interest rate adjustments spark transient fears over consumer credit health, retail participants on modern brokerage platforms frequently trigger automated stop losses or react emotionally to sensationalized headlines about emerging market debt. This routine liquidity event serves as a specialized feeding ground for institutional heavyweights. Long-term institutional funds, sovereign wealth allocators, and sophisticated growth investors use these periodic pullbacks to quietly absorb blocks of shares, steadily building strategic positions, while retail sentiment swings wildly between euphoria and despair. Trading volumes around major earnings announcements and macro data releases reveal a fascinating tug-of-war. For instance, when New reports record-shattering financial metrics, such as a monumental second-quarter net income surpassing $1.10 billion, alongside an annualized return on equity sustaining a remarkable 33%, the stock experiences sharp upward repricings that catch short sellers and hesitant retail traders entirely off guard. Yet institutional accumulation is not merely reactive, it is structural and backed by aggressive corporate capital allocation strategies, highlighted by newly authorized share buyback programs reaching into the billions of dollars. This signals to the market that management and major institutional backers view the equity as fundamentally undervalued relative to its multi-year cash generation potential. The intraday order flow of NU stock often showcases a distinct pattern of institutional absorption during morning volatility, followed by steady upward drift as market makers adjust their risk profiles to accommodate expanding fundamental values. Retail investors frequently find themselves chasing momentum after the gap-ups occur, having been shaken out during the quiet consolidation phases where institutions quietly build their heavy allocations. Now, let's pause right here and bring this directly to you. Are you currently holding a core position in new holdings through these volatility cycles, or are you sitting on the sidelines waiting for a deeper macro pullback to establish your entry? Drop your thoughts, your average cost basis, and your strategy in the comments below, and let's dissect how you're positioning your portfolio for the next leg of this digital banking revolution. To appreciate where New Holdings is heading, we must shatter the outdated historical framing that categorizes the company as a simple startup credit card issuer founded in Sao Paulo back in 2013. In its early years, skeptics dismissed Nubank as a niche fintech disruptor, handing out purple plastic cards to underbanked consumers in Brazil, predicting it would inevitably collapse under the weight of credit defaults once a severe economic downturn materialized. That legacy narrative is utterly obsolete. Today, New Holdings has evolved into a fully diversified digital financial ecosystem spanning Brazil, Mexico, and Colombia, operating under full banking licenses and transforming from a single product disruptor into the primary financial relationship for tens of millions of households. The modern operating model of New is built upon a high-velocity, multi-layered monetization engine driven by three core pillars: NII, fee-based services, and transactional float. Unlike traditional financial institutions that rely on heavy physical branch networks to cross-sell products at exorbitant internal costs, New leverages its digital platform to seamlessly upsell a comprehensive suite of financial services, ranging from instant payments and high-yield savings accounts to digital investments, cryptocurrency trading, personal loans, and customized insurance products, all integrated within a single frictionless application interface. The financial mechanics of this model are exceptionally robust. Gross revenue streams continue to scale aggressively, crossing multi-billion-dollar quarterly figures, with robust net interest margins expanding well past 20%, while risk-adjusted net interest margins climb above 12% due to disciplined, data-driven underwriting models. The efficiency ratio has compressed dramatically over the years, down toward the 29.5% range, reflecting world-class operational leverage where revenue growth vastly outpaces operating expansion. Furthermore, the average revenue per active customer, RPARC, continues its steady upward trajectory, proving that as customers mature within the ecosystem, they not only use more products, but generate disproportionately higher lifetime value at virtually zero marginal cost to the platform. This is not a traditional lending institution reliant on legacy spread income alone. It is a hyper-efficient digital utility where fee income and transactional float contribute massive chunks of high-margin profit, shielding the business from pure credit cycle dependency while cementing deep customer primacy across its entire geographic footprint. Looking out across the multi-year horizon, New Holdings is positioned at the absolute center of several monumental growth catalysts that will define the next decade of digital commerce in Latin America. The most immediate and explosive catalyst is the accelerating expansion outside of Brazil, particularly in Mexico and Colombia. In Mexico, where New has rapidly scaled past 16 million customers, the business is currently operating in what management aptly describes as day one of its life cycle. The deposit gathering engine in Mexico and Colombia is injecting massive quantities of low-cost funding into the balance sheet, providing a pristine runway to deploy higher-yielding credit assets into underbanked populations that have historically been ignored by inefficient local oligopolies. At the same time, the integration of cutting-edge artificial intelligence platforms across customer service, risk assessment, and personalized product recommendations is creating an unassailable competitive moat. by automating the vast majority of customer interactions while simultaneously sharpening credit underwriting precision. Nu is able to expand into higher-risk, higher-return mass-market segments without suffering the catastrophic default spikes that typically plague traditional lenders attempting similar expansions. Regulatory tailwinds also favor institutionalized digital rails, such as the rapid adoption of instant payment infrastructures across Latin America, which continue to drive transactional velocity and displace cash usage on a massive scale. However, prudent investors must maintain a clear-eyed perspective on the risk factors. The most prominent structural risk remains exposure to macroeconomic volatility, inflationary pressures, and potential shifts in sovereign credit cycles across emerging markets. While Nu's delinquency indicators and 15 to 90 NPL ratios have demonstrated remarkable stability and seasonal improvement, any severe macroeconomic shock or sharp contraction in consumer purchasing power could test the resilience of its unsecured lending portfolio. Additionally, execution risks surrounding international scaling, particularly navigating complex regulatory frameworks and competing against entrenched local financial giants in Mexico and Colombia, requires flawless operational discipline from leadership. Capital expenditure cycles and ongoing investments